Unbanked is a very important topic, and if you go back decades, there have been several business models which try and provide financial services for unbanked people, principally in the United States, but in other countries as well. And usually they focused on two things. One is lending at high rates, or in some cases, the student loan, there's been a student loan product where you make student loans available to people to attend for-profit schools, which typically don't produce much value, and there's extremely high default rates. So both of those models have ended badly. Yes. And I think you could say that at the financial crisis, a big result of the financial crisis was the fact that 10 million Americans, 5 million Americans went through bankruptcy, 10 million were in serious delinquency. A lot of the cause for the origination of the CFPB was due to that whole problem. The issues include that there's not much information about poor people, there's not much revenue from poor people, the origination costs are very expensive, and it's therefore hard to have a profitable business model. So what's changed? And I think that's the point of this panel, because we have 4 companies here which have all cracked the code on that. They have interesting models to lend money or provide services to poor people profitably, and in many cases with very low customer acquisition costs, and they're building financial arrangements with millions of customers. So I don't think, honestly, you could have created a better group of people to talk about this, and they have very different backgrounds, and what we want to do is dig into some of these distinctions now, so we have hopefully a substantive discussion. So the first is Shivani Siroya. She founded Attala Credit, which lends money starting in Africa, but now in 15 countries or something? How many countries are you?
5.
5, okay, 3 million customers. And she started the company in 2014. It's made quite impressive progress against long odds. So she's extremely very expert on this issue of lending to unbanked people outside the United States, of which there are more than 2 billion. Chen started a company called Propel in 2014. A lot of class of 2014s. Their product is called Fresh EBT. What that does is it enables people who are on food stamps to navigate the food stamps program. So they currently have about 2 million users who, on average, check the app about 9 times a month. Essentially, it's like a mobile banking app for people on food stamps. There are approximately 40 million people on food stamps, 17 million households, and $70 billion is paid through EBT programs. So it's also a very, very large benefit. And Angela Ceresnie, she was actually co-founder of Orchard, which was a data company for marketplace lending. Her new company is called Credit, and this is addressing this issue which I mentioned before, which is many people are attending training schools that give you skills to get a job, and that could be anything from becoming a welder or becoming a coder. Many of those are bad schools. They don't add much value to the education. So Credit's idea is how can we lend to those people knowing there's a very positive ROI? And how do you help those borrowers navigate that? How do you help, in fact, lenders navigate that as well? And Palaniappan is the founder of Earnin, which was previously called
Active Hours.
Active Hours. And Ram also cracked the code. Everyone's heard of Payday Lending. Most people would consider that a very bad activity. They don't disclose how many, but let's say over 1 million, maybe millions of users who are tapping into this application to borrow against money that they have earned. And it's ingenious, and what I find fascinating about Ram's story is he founded the company by building an app for his friends to do this. And so it was actually out of that experience, and then found that the word of mouth was so significant, he said, this should be a company, which has proven to be a very good insight that you had. So here's how we thought we'd do it. We're going to start with Ram and then Angela, because both of them cracked the code on an existing there were other companies, 4 profitable companies that were doing it and not doing it well. How did they fix it? So we thought we'd start there. Then we'll go to Jimmy talking about a brand new product that never existed. And then we'll let Shivani talk about the issues outside the United States. So why don't we start, and maybe Ram, why don't you talk about the issues of customer acquisition, insights into credit losses, some of the information gaps that make it so hard to enter this market profitably.
Yeah. So just stepping back, I think there were a couple of areas where you said it was tough to crack the code, and two of the other ones were that the unbanked is a customer that is not good from a revenue point of view, and that data was not available. I actually don't know if I'm aligned on that. I think the unbanked pay a lot for credit. They pay $35 on an overdraft fee for a $40 credit. So there is a lot of revenue to them. They don't get the rich man's credit product, which is 6%. They get the poor person's credit product that is monetizing far higher. So there is a lot of revenue because they have no choice. But we don't like to talk about that because we want everyone to think people are getting 6% interest rates and they're not getting it. So there is a lot of revenue. And data, again, is, I think, very bifurcated. There is a lot of data on people now with smartphones and things like that. It's not the data that the final system is used to using. But there is data, and so I think what you're able to work with. In terms of what we do, I think one of the things is, essentially what we build is a payroll system. We can keep track of how much someone is earning in real time, and then we let them pull down their earnings. So instead of it being a push-based payroll system where the company pushes out payroll every 2 weeks, we let the employee pull it down whenever they want. And so what we built was a payroll system, but it lets people avoid a whole bunch of different types of short-term credit products, whether it's late fees on bills or overdraft or payday loans, but people can get out of short-term product by having access to their paycheck.
Yeah.
And so essentially, I think what we've done is we've taken a different product, but been able to repurpose it in a way that fulfills the same need of needing money when you're short of money.
And how often are you wrong about that lending equation? In other words, the losses are different from what you expect, or there's fraud. How much is that? Because that would be the big barrier that most people would anticipate. And how much has that turned out to be?
Because of the way we do this, we're like a payroll system. Our losses would be high for a payroll system, but they're a fraction of like an American Express credit card.
Right. Okay, Angela, why don't you talk about how you crack the code on this?
Sure. Thank you for having me, and thank you everyone for attending. So Climb Credit, we partner with vocational schools and other types of training programs that offer certificates and degrees to people who can then go ahead and leverage those immediately in the workforce. So the idea is that the programs we're working with lead directly to career outcomes. And historically, the challenge in student lending, and particularly in this type of student lending, has been a few things. So one is Hans's, I think, initial point, which was that there are a lot of schools out there, and not just in the for-profit space. There's a lot of schools out there in general that don't have good outcomes. So today, 40% of people who start a 4-year degree don't finish in 6 years, okay? And that's just kind of the tip of the iceberg in terms of the scary and terrible stats that you can hear about student lending. So one thing that we've done as sort of the basis of the company and as our mission, which is to expand access to quality education, is we only work with schools that are delivering good outcomes. So we actually diligence and underwrite every program that we work with at the time that we bring them on, and then continue to monitor their graduation, placement rates, and the salaries that people are earning when they graduate. And that is sadly a unique feature of our business as it relates to education finance. And one that we believe over the long term will make Climb a more impactful company to the market, but also will help us manage our loss rates, and that's proven out. The second is every school that we work with agrees to take what's called a risk share, which means they participate in the loan alongside Climb. So historically, when you think about education finance, student shows up, they get a loan, and the school gets all of the money when the student enrolls. So what happens is the incentives are aligned around getting the next student to enroll, not necessarily making sure that the students you have in the classroom are getting the jobs and getting the salaries that they should get on the other end to be able to pay the loan off. And so by asking schools to take a meaningful share in the risk alongside Climb, we're able to do two things. One is be able to price more appropriately, so we can price to the school, not just to the student, and be able to offer reasonable rates. But we also incentivize the schools to care about how their loans are performing and whether students are going to be able to pay them off.
And is the feedback loop, it seems that the feedback loop is pretty long on that, though. Like, how are you, it's hard to get data about long-term impact. Historical data from the schools isn't forthcoming, and then you're pricing this, and then student has to get trained, get out, get a job. Is that enough to make the adjustments in pricing and changes in credit
Yeah. So the good news is that a lot of our programs are shorter duration. So I think our average certificate program that we work with is somewhere between 3 and maybe 6 months. And so the duration on our loans is typically about 3.5 years. We do some 5-year loans. So the feedback loop is, not immediate, but it's not what you would, require from a 4-year university.
Right.
And
so philosophy majors at 4-year colleges are not part of your...
They are not a part of our program. So we are financing people who are learning to be truck drivers, welders, heavy equipment operators, teachers, tattoo artists, dog groomers, all
the
kinds
future
of
of
stuff.
America.
All kinds of stuff. You pay people to do those things for you. They make a living wage, and it costs somewhere around $10,000 to get all of those certificates. So, which is reasonable. But finally, just on the acquisition side, the other code that I think we've broken here is by having that relationship with the school. We aren't paying to acquire each and every loan, but we're actually investing in a relationship with the school, which benefits us because that means we know the schools are good, which means the loans are going to perform, but it also means they're sending us students through their admissions process, so we're not having to kind of play the direct mail marketing game that some of the other lenders that have been in this space have had to play.
Great. So Jimmy, so you started with a product that didn't exist, and there was no one ever tried to do this before. And so what have you learned so far about the nature of the relationship that you have with these customers, and does that then extend into other types of financial services? And how much do you know about their behavior you think will be predictable about how they're going to perform, for example, on paying you back if you lend them money or something?
Yeah, the product didn't previously exist, but when I explain kind of the situation and the context, I think you'll agree that the need is quite clear. As Hans mentioned, there are 40 million Americans who get food stamps right now. They get them on a debit card called an EBT card. It looks like this. And when you talk to people who get food stamp benefits on an EBT card, they tell us that they check their balance by calling the 1-800 number on the back of the card before they can go grocery shopping. And if they overspend their balance, the whole transaction gets turned down at the cashier. They get embarrassed at the store because they're outed as a parent trying to pay with food stamps. And so people call this 1-800 number all the time. So our product is really just a mobile banking app that replaces that 1-800 number with a way to check your balance that feels modern, like it belongs in 2019. To Hans's point, we really see that as an on-ramp towards something else. We can solve the problem of helping you know how much you have left in food stamps, but that's not the ultimate goal. The ultimate goal is helping that person to improve their overall household financial health so that someday they don't need food stamps anymore. Our interest in sort of the unbanked and the underbanked in the United States is that when you talk about the folks in the United States that don't have a trusted, high-quality, high-loyalty core banking relationship, you're disproportionately talking about the people that also get food stamps, right? These are very low-income folks who navigate a bunch of financial services that are really expensive, extremely low trust, and that aren't very sticky. And so our opportunity, and what we're trying to build at Propel, is the opportunity to build trust directly with the consumer that doesn't have a lot of financial services loyalty right now, and to onboard them onto services that are increasingly more positive to their financial health as they build things like a checking account, as they build their credit, and so on.
Mm-hmm. So I do want to we're going to come back to some of these topics here about these 3 programs. I think it's interesting. All 3 are addressing something with profound public benefits, and they're doing it in for-profit companies. So all of them are enabling people to navigate a complicated system. I think Ram put it well, which is if you don't have working capital, you're excluded from a lot of these things that we take for granted, and all of you are coming up with something which is actually very much in the interests of your customer, which I think is different from many of the historical models which have been based on trying to trick the customer into a profitable relationship. And so that's really anathema to what they're doing. But let's talk about outside the United States, because pretty much when you enter these countries, there is none of the traditional credit infrastructure. There are no bureau scores. You don't have authentication tools. How did you start with one country and then talk about how you overcame that?
Yeah, I mean, I think what you're saying is exactly right, where yes, the problem is access to liquidity, but actually, if you don't rebuild the entire credit infrastructure, and I would say like the credit stack itself, you actually can't solve that problem. And so we did have to go piece by piece and actually say, okay, how are we actually going to do KYC? How do we do identity verification and fraud at a global scale? And so I think there are these similar opportunities now in emerging markets around the smartphone itself. And so actually realizing, okay, we almost had to constrain ourselves from not going and meeting the customer in person, doing loan applications, doing any of those things, and actually saying, what can we gather from the device itself, and what can we gather by really understanding the customer's behavior in our application and their financial mindset or anxiety from the start. And then from there, we said, okay, now that we know the customer is not fraudulent, now how do we start to think about this concept of capacity and then creditworthiness or the likelihood of them repaying? And then the last piece is actually now how do we service them? And so in our markets, not only are there not bureaus or national ID systems, there's not even actually a aggregated payment system. And so what we had to do was actually then say, okay, we're going to aggregate in-person bill payment centers, retail chains, mobile wallets, bank accounts, any of these different things that the customer may actually want to use their money at or pick up their cash into one application. And so I think that's been the really.
And are you finding that this issue, like the build is the same in each country? You go to Kenya and then you go to Tanzania next, or where did you go next? Or what was
We actually went to the Philippines.
Philippines. And so did you find the issues in the Philippines were the same as in Kenya?
Not at all. I mean, I think similar issues around lack of credit infrastructure in the sense of bureaus, identity, things like that. But the rails were very different. And now I would say actually, now that we've worked in markets where you've got predominant mobile money systems, where you've got a lack of kind of payment rails like the Philippines or Mexico, and then all the way to in India, we actually do feel like we've got all the archetypes. And so now it's a lot easier to actually go expand.
And are you finding is fraud very different in each country?
It's not.
It's not.
And actually what's interesting is by working across these 5 different markets already, we've actually realized every time, if we do get hit with fraud in a market, it actually makes it that much harder to hit us in any other markets. And so the way we've done it is actually just layered models on top of each other. And so our fraud defenses actually get smarter, and it's, again, more about the individual and less about what macro data or kind of traditional data would be.
It's interesting. We found that fraud is very different in different countries, and sometimes inexplicably. So fraud's really high in Denmark, really low in Sweden, and really, really high in Egypt, very low in Morocco. So you got differences that are not readily explained, but you haven't found that.
Well, what we think is, the majority of the population is creditworthy and not fraudulent. And so what we're doing instead is really saying, okay, how do we limit folks that are actually, doing calculated fraud, and where you actually know that coming in, and then how do you actually segment and price accordingly to the risk that you may be taking?
Yeah. So I think 2 big issues, to me at least, extend across all 4 of you, which is, number 1, how do you take this relationship that you've built and build it into something more? And the second thing is, all of you are operating in an area where the regulators haven't necessarily anticipated this as a business model. So, so the regulators, you start getting big, regulators are always interested in this. How do you stay on the right side of the regulators? So I think this is something all of you can share in. But maybe, I don't know, who would like to start on the building a broader does this become the anchor of a financial services relationship? And maybe, Ram, do you want to start with that? What do you think?
Sure. So I think with what we have, I think it's interesting starting point to build more. One of the things that we have is we're able to see earnings in real time. And when we're able to see earnings in real time, it does 2 things. One is it's really engaging because people like to keep checking their earnings. So our app is open about 25 times a month on average, which is super high engagement, which means you can start interacting with them on other pieces as well. And then we have this 2-week window, and we know that somebody has money, but the rest of the financial system doesn't. And so we have that visibility in how much money they have, what's coming in, as well as a lot of contextual information because the data that we have, that we can start helping people make real-time decisions with their money.
Yeah. Jimmy, what do you think about this becoming more the anchor of a financial services relationship with multiple products?
Yeah, we started Fresh EBT sort of to replace calling that 1-800 number. So it really started off as just a balance checking app. It was like the only feature that we built in the original prototype version of the app. And we've expanded that already into more than just balance checking, into things around helping people save money through grocery coupons, helping people find jobs through the platform and see what other opportunities are available near them. So I think we've had kind of the start of this. I think we want to continue moving in that direction because we think for this demographic, the challenges that they have are much broader than just knowing how much they have to spend in food stamps or being able to make small wins here and there. There are these big systemic challenges. And so I think a lot of our bet is that by having a trusted relationship with this consumer where we're offering them something of value that's actually directly meaningful to their day-to-day lives, can we start to leverage that and kind of creep that out into the broader aspects of the financial system that are really important to these folks?
Yeah. And Angela, I don't know, I'm not sure your product is the same, but it's a powerful idea, like predicting ROI on education is like a big idea. But what do you think about what the company could become?
Yeah, so I mean, I think similarly, the feedback we get often from students who are financing is, you're the first lender to take a risk on me. Thank you for enabling me to change my life. Because the reality is that a lot of the students that we're financing, similarly in some ways, don't have a positive experience with traditional financial services. And so I think that there's a couple things. One is, the point I think you're alluding to, is that we get a signal. Someone's going to this program, they kind of look this way right now. We now have a signal that they are now step functioning their earnings. And so I think that there's value in having that information and making sure that you're there. We can be a trusted advisor in helping them understand how to navigate what to do with that income once they have it. One thing we're even doing now is sometimes we help finance some living expenses for people while they're in school. We want to start delivering that on a credit card.
Yeah.
As like starting as a debit card, and then over time that can be your credit card. A lot of these people don't have credit cards or wouldn't qualify for a credit card that has reasonable rates. But the other thing I think even bigger is helping people navigate their skills and where they are in their career and what their potential is. And I think as we have more and more schools on our platform and understand the career paths of what people who attend those schools do and how they kind of go about their careers, we can then give some of that feedback back to the students that were either they're on our website considering going to school, or those who have graduated and later want to continue to increase their earnings. So I think there's long-term potential to really help people navigate that piece as well.
I think it's also all three of these companies. If you think about it, like one of the biggest issues in bureau scores is they're very good at predicting the past. They don't predict the future, and if the future is the same as the past, they're great. But if in all three cases you're talking about customers who are trying to change, they're changing, and you have insight into this, which is not available. That type of, there's no good predictor of that, I would say, for anyone who's particularly below like a 650. It's very sloppy, and you don't have good signals at all about who's actually changing. But what about, you have probably the biggest opportunity in this, because you're not really displacing any financial relationship.
Yeah, I mean, I think it goes back to the fact that, I mean, we don't think of it as what we're providing is just liquidity. We really think that the way to actually include people into the financial system is that account and that identity. And so, yes, ultimately the value we provide today is liquidity and capital access, but it's actually the fact that we've developed that relationship. And so, already what we're seeing is customers are actually using that account in a way that we've never even thought of. Where, yes, we put in money, but actually when they repay us, sometimes they'll actually give us more than is actually what is owed. Because they're actually saying, I trust Tala, and I don't actually have a savings account. I don't actually have a better place to put it, and I actually want there to be a little friction, otherwise I'll spend it. So that's like use cases that we're just organically seeing. Or customers actually saying, can I leave the money in there? Because I don't need it today. So just really, really interesting stuff of how we can help people manage money, how we can help them use it over time, and actually connect them to the broader financial ecosystem. But I think what all of us are saying is it starts with that idea of trust, and I think all of us being willing to take that first risk on these customers.
Okay, well, we have like 5 minutes more, I believe, but I'd like to talk, we're happy if someone has a urgent question, but I do want to talk about this regulatory issue. So I think how, maybe we'll ask each of you briefly to just say, there are no, and if we don't, maybe not all of you have to answer the question, but there are no regulators specifically addressing what you're doing. So how do you stay ahead of this? How do you frame out, how do you create a regulatory guidance or framework you think that will make you be viewed positively? So I'm going to start with Shivani. We've been going this way, so I'm going to go back. What do you think about that? And how much do have regulators come to hassle you yet?
No, not that much. I think they've been actually very interested in our work. So what we've done is proactively gotten ahead of it. And so we've put out our own data ethics policies, our consumer protection policies, data privacy, all of these things actually front and center in the app and on the website. And so in some ways, the regulator is actually kind of trying to understand us. But what we've done, just because there is nascent regulatory environments where we work, is actually said, let's take the most regulated environment, like a Mexico or an India, and actually just use those policies across all our markets.
And do you go to the central bank and talk to them first before you launch?
We do. So we talk to the central bank. A lot of times we'll talk to the actual treasury, et cetera, and actually just show them what we're doing and produce our impact reports for them to understand it.
Yeah. And Angela, you operate in an area where there's lots of newspaper articles written about how bad this is for the United States, and what do you do? And regulators care. What do you do?
I think our biggest, so in terms of regulators, we have sort of the regular state lending license regulators, so we're talking to them all the time. But you have, I think for us, the biggest challenge, or potential challenge and risk is the headline risk, right? Of a school we're working with doing the wrong thing. Interestingly, in the last few years since Climb's been around, the schools who have been exposed as doing the wrong thing, like in any type of press coverage, have all been schools that either we weren't working with because we didn't know about them, or we had looked at them and could tell.
Right.
So obviously that's not necessarily a perfect answer, but I do think that our deep focus on kind of students first and advocating for students and wanting to make sure that the programs we're working with are delivering results gets rid of a lot of the bad players.
Yep.
And then aside from that, we're lending.
Yep.
So that's a pretty straightforward regulatory.
You're regulated, yeah, for good reason. Ram, have any regulators come to you yet? Have you had any?
So we've had lots of interactions with regulators, state as well as CFPB. The CFPB actually, in their rule, the old one, the old CFPB,
Right.
has like a fairly explicit carve-out for us because they recognize the policy objectives that we help meet. And this is the piece of legislation that the CFPB is now trying to roll back. But we've engaged quite a bit with regulators.
Good. Jimmy, any feedback from you don't have a specific regulator, but any states or EBT police come after you yet?
Yeah, it's not only do we not have like a specific regulatory example that we're following, there's not even like really a regulatory body that looks after organizations like mine. We're functionally the only company that exists that's trying to build software on top of the food stamp program while not being an official vendor of the state government.
Right.
So I think we're doing a lot of like trying to convince the state and federal government that we are on their side and that they should take us out of this gray area where they're sort of concerned and not sure what to do with us. For us, that argument just starts with the fact that I think we share the same goals.
Yeah.
Our goal is to make this federally funded program a lot more efficient. We did a study with Harvard a few years ago that showed that someone who uses the Fresh EBT app gets the equivalent of an extra day of food stamp benefits per month. So we're stretching someone's food stamps by a day per month, and that's a way to make these $70 billion in taxpayer funds go a lot further through modern software, and that all state and federal policymakers ought to want that too.
Okay, so I think we are out of time. So if you have questions, you can grab them afterwards. I think all of us should be very appreciative not only of the capabilities of each of you, but each of you focusing on something that's providing so much real substantive good around the world. So thank you all. Thank you all for joining us.